this is London with MarketHedge. Let's talk about Bitcoin in terms of the overall patterning. I want to discuss this flat top resistance at 117.5 and the fact that the bulls are trying to pick up along a level of support. If you'll back out on the 4, 6, or 8 hourly, even on the daily time frame, you will see this line of support. I've added an external feature here and an internal trend line. So a support line that has a bit of an outside barrier or threshold to it. This is London, former hedge fund owner, private, non-SEC, not financial advice. We're also going to cover very quickly tonight, because I realize I haven't discussed this, what is a hedge, okay, in the most classic sense of the word. What is a hedge? Let's talk about that on the 4 hourly. We discussed quite a few times the most conservative trades on Bitcoin, the highest probability trades that we see that I bring you, and guys that have been extremely successful over the preceding number of weeks have been what? In and along the 4 hourly RSI, Relative Strength Index. Now, to explain exactly the hedge in the most classic sense of the word, I want to describe if we were to have gone into shorts here. Let's say that you secured a position in and around this zone. Now, I have RSI charted out on the actual price chart. I have derived from Wilder's original formula the actual placement or the actual price at which RSI on the 4 hourly, it is multi-time frame, or the daily, right? Whether or not, or let's say exactly where, price is oversold, or at which point it is oversold, or whether or not it is overbought, or exactly at which price it is overbought. So that's the extrapolation. That's the visual that you see in terms of Wilder's RSI formula. I frankly don't see why more people don't do this, and it's extremely helpful, especially as we're considering one of the more highly probable, very highly probable, let's just say, levels of interaction and potential pivots or reversals for Bitcoin. Now, in terms of those details, let's go ahead and map out the regular RSI. Let's bring in that oscillator so you can bring that, so that we can discuss that in a more traditional sense as well. Now, there are two things that can happen, really three things that we discuss very frequently. However, in this specific instance, I just want to focus on that key focal question in the traditional sense of the word: what is a hedge? Now, as we've been discussing, a hedge has been an asymmetric move, number one, right? An asymmetric move, meaning we break down from a pattern and we want to hedge, meaning while the market is looking down, we actually want to be buying. And we want to, yes, catch that pullback or that throwback to that preceding level of support, essentially that breakout zone. We'll stack in this area, right? An asymmetric trade for that throwback or that pullback. That's kind of the first issue that we've been discussing, or definition we have been discussing of a hedge, right? You're operating against the market on Bitcoin. This is the 4 hourly chart. You'll see here that interaction over bought. You'll see the interaction here oversold. Now, in terms of that, which corresponds to the specific overbought here on the RSI indicator, you're seeing that on the oscillator, and the oversold here on that oscillator again. Now, in terms of the second feature that we have discussed in terms of the definition, explaining what a hedge is, not only is it one, that asymmetric move, let's say, but it is also the notion that the buyer or the participant in the market would not want to be fully exposed at any one position or at the original position, and instead of putting an all-in specific order, okay, to catch a position and be fully exposed with his or her whole cash position, no, he's going to ladder in, right? He's going to put specific orders in and have a percentage of exposure at each level, right? So in that sense of the word, if we were to just look at this and just imagine that the trader, let's take away these arrows, he's a little bit distracting here. So to the extent that we defined, the first issue was asymmetric, right? Going for that throwback, operating against the market, hedging the move. Now, in terms of the secondary feature here, it is a limitation or a fractional approach to your investment, okay, or to a trader's investment, not yours specifically. And remember, this is London, former hedge fund owner, private, non-SEC, not financial advice. Looking at the details here, though, you start to see that a componentry or an approach that would allow a trader to scale in, meaning, okay, orders are stacked, which does what? Which actually allows the trader to say, let's just imagine a big financial desk in New York, okay, at a major institutional desk, and the trader's got $10 million to work with, or 15, 20, or let's say up to $50 million in this range to work with. Well, the trader decides, I'm not going 10 million, or let's say it could be $10, guys, $10,000, whatever the example may be, but I'm not going fully all in right at this level, right? Instead, I'm going to spread that $10, $10,000, $10 million. I'm going to spread that in terms of whatever long interest may be realized. I'm going to spread that over a specific area. So that accomplishes a hedge in a different sense of the word. Why? Because the entirety of the capital is not deployed in this zone. In fact, the bulk of it is hedged or held back from that operating position. If and to the extent price were to come all the way down, that's when there's a full level of exposure, but not until then. Thus, that partial exposure at each level and the incremental, we could say the incremental exposure at each level down. And remember, still, we're what? The first part of the definition, we're still asymmetric, right? Okay, so the longs are deploying, but they're deploying at an incremental level to where the entirety of the exposure is not accomplished until there is, let's say, a maximum defined at a specific range, right? Until the bottom feature or until the threshold is met, at which point either a capital maximum or some other technical feature or limitation will be met in the market or by the order placement. So that is a secondary function of the hedge, in that, and a description here, in that the trader is not fully exposed at the original position. So we have one, asymmetric, right? That's the notion that we're operating typically against the market, looking for a throwback or a pullback, right? Which if you guys have traded a lot, you know it's often those are the guys who will wind up looking like shining stars at the end. You guys will agree. Everybody in the market's going long except the guy who catches it going short, right? Okay, in terms of that. And nice video on Friday. Please review that video on Friday, and it'll go into the third part of this explainer on the video. So the first part, asymmetric. The second part, the limited or fractional incremental amount of capital exposure. We agree? Yes. Now, so those are two hedging principles. One, against the market. Two, it's like, well, I'm hedging. I'm only giving you a part, and then another part, then another part. So hedging in terms of that overall capital allocation and the risk. Now, the third, and this is really the most classic sense of the word hedge, depending upon what circles you've spent your time in finance and trading, or just in life in general. But the market has a very nice way of allowing a trader to, if a trader is, for instance, let's just imagine that a trader wants to lock in a short position. Let's forget the underlying positions that could be, but a trader wants to lock in a specific short position. Let's say that same trader at the desk who was over here, and he was working with whatever he's working with. Let's say down a few desks from him is someone who specializes in shorts. The trader at the 4 hourly decided, okay, now here I'm going to step into the market, and I want a 10. Let's just say, guys, it could be $10. You guys got it. It could be $10,000. It could be 10. We're going to put M right here. We're going to put $10 million right here. Now, to the extent that that trader has a short interest at this level, okay, there we go. Now, short interest at this level of the 4 hourly RSI on Bitcoin. Now, why might the trader have done that? You know that we went through a few charts. We had a nice parallel carry up. If you didn't catch the chart on Friday, it's just a nice parallel carry up level of resistance that was hit. Let's just imagine, for whatever reason, it was just a standard, say the trader's job is on every 4 hourly high. His job is to try and secure, or definitely secure, a $10 million net short interest, period. That's his job. Now, in terms of that can operate in and of itself, or it can operate in conjunction with, or as a profit protecting mechanism. Please pay attention. This can operate as a profit lock, essentially, if you'll allow me to describe it as a specific way of locking in profits. Imagine that the trader here has a long interest, or it's from a let's say either from this zone or from lower, wherein a $10 million position at this point will lock in the profits from an underlying long position. Now, I can separate this out to where you can understand it more clearly on the downside if we don't have this example. But the notion would be, okay, trader is carrying up, or someone else in a firm is carrying up, likely for you, it's going to be you, are carrying up a long interest in profit to the upside. Now, you do not want to, let's say we run into a primary level of resistance and you do not want to bear the risk to the downside, and you want to capture or secure all of your profits. In which case you would have a discernible, and I just say a calculable, literal level at which point you could say, okay, X number of dollars, and it's going to be calculable. I hate to get in terms of mathematics, but you'll have a discernible that is an exact amount of interest that you could enter into a short at this level, right? At this specific level, and essentially all of your profits from the downside would be secure. All right, so every long interest, and just pay attention to this, all the long interest that you have from the underlying positions, from any underlying positions, essentially are going to be locked in by these shorts. Okay, so I guess the best way to think about this is the following. Let's remove this long interest and just focus on the shorts. If this is for a lot of you who have been around for a while, you already understand this. You understand that you can lock your profits in from an underlying long with a short, correct? Absolutely. You understand that if you've been around for a while. To put this in kind of an immediate context where we don't have to imagine having a long interest from underneath, which I know probably 95% of you do, okay? But in terms of this specific position, let's say that you caught this specific area or threshold, this specific trade at this 4 hourly with a $10 million short or a $10,000 short, whichever, just choose a number. The effect of that would also be to clear you up in this zone if you'll pay attention. This is another way of looking at this. It's going to be an additional in terms of things that we've discussed and understanding, whereas you've been able to understand locking in your profits with the potential at any let's say at any likely pivot or likely reversal zone entering into a short. We've discussed that many times in terms of locking in that profit from an underlying long. Let's say that now the focus is on this zone in here, trading the comeback. This was one of those Asia pour down sessions where I won't say we're surprised because we had that Friday tape. We had the specific carry up from that lower region, but it was still nonetheless somewhat aggressive, right? It was Asia decided to pour down and didn't want to really stop. We had a few catches, didn't want to really get back with the bull momentum. We had that MACD, et cetera, that was just quit on us. Now, the issue or the benefit that you could have, and pay attention, the benefit that you could have had with a significant or let's just say any type of relative, even on a relative basis, doesn't have to be large, but on a relative basis, the notion that you would have a short interest above would do what if and to the extent you decided to power in with longs in this zone. Pay attention. To the extent that you have or you entered into a short in this zone, and this is part of this, let's just say the second part of the equation here, and I'm drawing off what? That preceding long, wherein this short has the relevance, okay, in that it's covering the long positions and locking in those long positions. Now, this is a new example. This is the example where forget the preceding longs. We're just focused on the shorts from above, okay? Pay attention. From the shorts from above, and again, it's as easy as we start this game on Friday, 9 o'clock. Bam, enter into a nice short, get pushed around a little bit, and by the early next start of this week, we're down. What would this $10 million short, or the $10 short, it doesn't matter, the $10 short here, $10 million, would have allowed you to enter into longs in this area with what? Pay attention, guys. It would allow you to participate in this zone potentially what? Potentially risk-free. Now, how is that? Okay, well, this is the second part of the equation. It's not more complicated. It is the same example that I brought up beforehand. It's just a further, let's say a further move down the road, and may have required two specific short, let's say an additional or new short position. Now, the reason as to how this would have, and if you trade a lot, you already get it. Like, okay, yeah, London, let's move on. But understand, the $10 million short position that we have secured up and around here would do what to the following? It would eliminate the risk, okay? And by eliminate the risk, it would still compromise profit. It would still compromise profit from what? Well, understand, as you're getting paid on the way down, and in terms of the short actually paying, what does it free you up to do in the market? To the extent and relative to the size of the position here on the short, you are enabled to, and you have the freedom to, actually participate at each of these levels or within the full range to the degree of exposure of the original short. Now, I can talk about this all day long, or you can see it on your own account. It'll make a ton of sense. The bottom line is, to the extent of the size of this specific short position that you may own, it allows you to operate, pay attention, it allows you to operate in somewhat of a cost-free manner as you try to pick up longs in this zone. Now, I say in somewhat of a cost-free manner because what is it really doing? Well, if you were to stack in longs here, pay attention, we're stacking in longs in this area, right? You've got the overlying short hanging on from this $116,000 area. Maybe you caught up, let's say a different metric right on that carry up that we saw at the 117.5. Now, to the extent that you still want to go long in the equation with Bitcoin, that would be the premise here. You still want to go long. You've got a protective short that have locked in profits, right? That's the discussion. And to the extent that we still want to go along with Bitcoin, right? Each of these longs are going to cost you what? If they're appropriately gauged to the original short. Each of these longs, if they're appropriately gauged in your capital exposure here at each of those longs, is in a proper, okay, in a proper relationship, or in a proper, let's just say properly proportional to this overlying short. That is, well, you don't want to put $1 into your short and each of these are $10 necessarily. That would be one approach, but you're risking on the loss of the longs. To the extent that you're in proportion on the longs below the short, and what you have to realize here is as you're going down, the short is doing what? It is paying. Correct. So as you're trying to pick up in this zone, as long as you're in proportion to this top specific short, this may cost you nothing. Okay. Now I say cost you nothing relative to the profit, okay, beyond the profit exposure on the short. Understand, and this is complicated, but I feel like in a classic sense here, we have to discuss this. It's a way to lock in profits, but it's also a way to participate as long as you're in proportion to an overriding short interest. The long in this area could cost you, and I'll say cost you what? Zero. Now, in essence, it would cost what? As long as it's in proportion to the size of the overlying short, it could cost you zero in that your short profits in this zone, in each zone, are covered. Your losses on the longs are covered with what? With your short profits. So, And again, why would someone do this? Okay, why would not to just have a headache in terms of an explanation of what a hedge can accomplish? But again, if we're trying to go down and rip to the upside, there may be a good justification for having a protective, let's say a protective shield or a lock-in profit on a short with a adequate proportion to the downside of longs. And this is the trick, the proportion of the longs to the shorts. You got it. Now, to the extent that we've gotten too complicated, the important thing is the following. If I erase everything on the board, but I wanted to go through this without getting into, let's say, just an academic level discussion, you've got shorts. What are they doing? They're paying on the downside. To the extent that you're locked in on a short, on a nice short, you know that your long exposure below is what? Essentially, if it were to power through and collapse here, it's going to create essentially it's going to create a no profit zone. If it's proportionally formulated and proportionally sized to your short, all it does is creates an area where your P&L is for that area should be zero. So your P&L is going to be zero on what? On your short, right? So that's the risk when I say it allows us to operate in kind of a risk-free zone. The real situation is here, and I want to bring this up because this was an important pivot here. So start to challenge yourself a bit. Start to think of what would it mean for me if, okay? What would it mean for me if and let's say for instance, pay attention to this part. For instance, on every single specific channel formation to the upside, please pay attention. You may count these with Elliott waves. You may have some sort of different technique by which you're going. Let's say even from the parallel carry down, which we had over here to the top, and I've mentioned that a few times. We can go ahead and draw that out. You may have any other metric. You may hit a VWAP. You may hit a moving average, etc., in and along this top zone. But the point is this: if you recognize in your own trading that typically when we get, pay attention on this, when we get beyond a specific threshold and we break down from a channel, call it a bear flag, which it isn't quite, call it a constructive pattern dynamic. A specific channel can be either a bear flag or it could be a constructive dynamic, meaning it's forming a pattern, right? The danger zone becomes where? The danger zone for the trader is right here. Once you're beyond the threshold of support, yes. So we watch this like a hawk. And I would not be saying this if this were irrelevant in terms of your profits, I would not be saying any of this. But the point is what? If we know that there's going to be typically a breakdown further beyond this specific level of support, what does the trader, based upon what I've just said, what would a trader have an incentive to do? Well, a trader would have an incentive to try and capture in this zone, yes, either a profit lock, based upon an underlying long. Yes, an underlying long, and I mean underlying, guys. Okay, when I say an underlying long position, we're talking, let's just throw this into context, into an underlying long position, okay? A profit lock from your positions at 80K or from your positions at 60K. You got it, okay? Or from your positions, it could be 40K. It could be, and I'll just move this up, it could be 15K, right? It could be 50, or let's say 15.5K for Bitcoin. It could be 25, 30, anything. Look, when I say lower positions and a profit lock, it could be relative as well, certainly. And it could be I'm locking in the profits from this move here, right? But typically I'm talking about lower entries. And there may be several locks, several positions that need to be locked in terms of the profits, okay, depending upon price action. And no, it's not simple. So to the extent that we're talking about this, that would be step number one as well. I need a profit lock somewhere. We're going to say somewhere. Now, where do we get an interesting opportunity for a profit lock? Bitcoin was very, very nice from a lower position. The red line that you see is what? The red line is the RSI on the daily. Okay, so as you're looking at a potential for a profit lock, and we're normally talking about the 4 hourly. Let's just take this 4 hourly off the chart here for a second so you can see what I'm talking about. As we look at the possibilities for a lock on the profits or a guarantee, kind of an insurance play with a hedge. As we look at it, the daily has been pretty nice recently. Near hit along the top. We didn't quite get a hit on that top on the RSI here, or if it hit, it did back down. But this is typically an area where we start to push it unless we have some kind of incredible pattern ongoing, which is a little tricky back in this area with this bull flag, if you guys will recall. But as we look at it, a trader might operate around a metric, and it'd be a combination of metrics, but one of those variables would be what? Would be the daily RSI high. Saying at each and every hit along the daily RSI high, I'm going to, through whatever means available, try to lock in profits. It may be on the weekly basis. It may be on the, guys, there may be a monthly metric instead in play. And to the extent that there's an excess amount of volatility at said point, there may be much less in terms of any types of leverage in play, period, okay? So there may just be a flat cover in terms of the absolute just spot cash cover of it. So and just imagine how that could play into the mix on your own analysis there. Imagine that in terms of increased potential volatility beyond your metric and the need to play at a flat or near flat, let's say at a spot position. Now, that would be for potentially those underlying, right? Those underlying, and talking about, let's say, those entries from 15,000, entries from 20,000. You say, well, how can I lock in my profits? Okay, you lock in your profits on a long with an equivalent short position. True? Yes, right? With an equivalent short position. Now, in terms of the details here, as we look back at this, that final metric that I want to kind of hone in on, just so you guys can understand, is pick up a game plan. If this is not the game plan you want, but you want to adjust it a little bit and you've got a better idea, hit me up. VIP in the back. Yeah, Luke, J-Mac, you let me know what your thoughts are. But the idea is the following here. Let's just imagine that Bitcoin can get aggressive beyond any specific upward channel formation. We agree? Yes, without a doubt. This is where you can get into the falling knife, right? Now, that gives an incentive to the trader along the way up, however it can be defined, again, whether or not it's a moving average, whether or not it's a constructive, let's just say it could even be constructive to the extent that you're at a primary preceding pivot or congestion area, right? Preceding supply or demand zone, whether or not we're looking at the shorts or the longs. What we're looking at is the potential to cover not just those longs, which we talked about, and I brought in the daily RSI. Again, it could be weekly or monthly, right? Especially depending upon the asset that you're looking at. But the ability to participate in this zone with what? With the freedom, listen to this, guys, with the freedom of saying, yeah, well, given the fact that there's a short position in play, that you own a short in play, you are now given the freedom to not be in losses in this area, but instead to be in what? To be instead just risking the profit on your short. So this is kind of a secondary, more immediate term where we're flipping the script and we're requiring a short up top to cover what? To cover our specific long entries here below. And we're sacrificing the profit on that short right on, as we were to, and now we're not necessarily catching a falling knife. While the rest of the market literally may bleed to absolute infinity, literally bleed to infinity, what do we have going for us? Well, the only thing that's being risked are the profits from the overlying short. Do you see? So this is just a trading maxim that I want you to conceptualize, to visualize, and realize the importance of allowing yourself to operate in some sort of a non-catastrophic manner as you talk about heavy cash reserves. This is a cash neutral, potentially cash neutral solution. Now you'll get beyond this solution and you'll ask, well, what does that mean? What does that mean if I've got longs and shorts and longs? There you go. And where's the next balance on the shorts? And to that extent, I have tried to isolate this specific short above to provide the individual dynamic or comprehension and the dynamic of what the effect is underlying, okay? And it is not a risk-free zone, but it is a zone at which, while the rest of the market may bleed, literally, right? Bleed literally trying to catch a falling knife, you are operating, and the worst that you can do on trying to pick up a long is what? The worst that you can do is power through the profits or chew through the profits on your short. So, for those of you who have listened, I know you understand it. I know you get it. If you need to rewatch it or ask me questions, hit me up in the back on MarketHedge. But as I started to really think through this solidly in terms of what we've presented, in terms of a classical definition of a hedge, I want to make sure that you fully understand. Yes, hedge, meaning, well, it's asymmetric. Let's go back through this real quickly, and this will be 2 seconds, right? A hedge, well, it's asymmetric, meaning what? Well, we're over a pattern, right? So we're going back to the pattern, this throwback. It's asymmetric, the hedge, right? That's part number one. Part number two is what? Part number two is, well, it's also a hedge in that I'm hedging my cash. I'm not fully exposed at any single particular one position. I incrementally add to the position, right? So my capital is hedged, my risk is hedged. So that's kind of the second part. We got one being that asymmetrical move. Everyone's going up, you're going down. Two is that incremental, right? The incremental in terms of those orders picking up. And then three, we have let's just call it, I don't want to call it a cross-profit dynamic, but we have and you already know that they're dynamic. The classical definition allows you to discuss things like insurance. And I mean insurance to the extent, not like you're going to buy for the car, the type of insurance where all you need to do is calculate, if I have a $10 million or a $10 position in Bitcoin long, what type of a short would I need? Let's say I have a $10 position long. What type of a short would I need to guarantee and lock in profits, right? From the low to the high, to where if I were to return back to the low, what? Yes, I secure my profits. Now, the example that we went over particularly today was intended to operate a bit further beyond the discussion or beyond the framework of what we have discussed already, right? But beyond the framework of guaranteeing or locking in profits, it's intended to bring you to the point as we look at a particular tendency of Bitcoin to get aggressive to the downside based upon the volatility and price action of allowing you to operate almost in the free and clear, right? If you can secure the position independent of that profit lock you want from your underlying positions, let's say from 20K, from wherever you're at, the ability to operate amidst the hemorrhaging of potential bulls in the market while they are bleeding, you're doing what? All you're going to be doing is literally chopping in to the short profits. You got it. To the short profits heading down, right? And you're essentially just going to be in proportion to essentially the position of this short, and all you're doing would be eating away at these profits, right? With your long interests as they were to essentially not cost you in the sense of the word that we would traditionally expect, a real loss in the account. Yes, right, or a real loss, any realized loss to you. Why? Because that short is just making money on the way down, so it gives you that leverage, that freedom on the way down as it makes money to do what? We'll say, I want to pick up here. I want to pick up here. I want to pick up here, 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 all the way through, right? Because that shorts, the profits are covering your long interests. So maybe a break even, right? Ultimate break even strategy based upon that original short entry. We'll just call it a cost cover mechanism right now, and more in line with the traditional sense of what the hedge is. Now, this is a longer form video for a reason. I wanted to cover more of the classic definition. I wanted to cover how this could be that this just doesn't hurt, and you're a bull and you're buying like crazy. How could it be? Okay? To the extent that you understand the discussions herein, I'm going to say you can rewatch it, or I can make sure and definitely cover this again. But this would be how the securing a specific short in and around this zone, right? We could say, or having secured a real primary short in and around that former top 125K. Let's just call it 125, just short thereof, right? So to the extent that you're new to hedging, that this is just all overly complicated, it doesn't make any sense. You're either going to stick around and learn about the market, or you're not. To the extent that you find this engaging and that you're connecting and firing on all cylinders, that's what VIP is all about. To the extent that you have additional questions, or you're already adding to this in terms of what your preferences are in the market, and tactically and strategically, that is where VIP and the relationships that we have, etc. That's where everything just starts to shine. So that's where everything turns golden, guys. What do you have to bring to the table in addition to these classical maxims? And the most important thing today is just realize again, this here, right? How would we make it? Let me finish this thought off. How can we make it from just a hemorrhage or the falling knife and a miserable experience to where you have the freedom to operate, chill, sit, and relax, and engage in some long interests? You got it. While the rest of the market bleeds, you're going to look like King Kong. Okay, if you can pull it off to the extent. Now, what's the trick? You got to get the short, right? You got to own the short, right? Yeah, you got to own the short to play like King Kong on the way down. We agree? Yeah. And then what? And then it's got to be in proportion to the short. All right. So I won't say a few other tricks here, but you could probably, if someone shows me what their long interest is on the way down and they tell me they're fully covered, I could probably figure out, you could too, in terms of at least what their short interest is, right? So those are beyond the scope of this discussion. What I'll say is it's been a pleasure talking to you today. Remember, this is London, former hedge fund owner, private, non-SEC, not financial advice, and this is Bitcoin. It is the riskiest, and I'll say the highest risk potentially and highest reward asset that we can focus on. So these types of discussions where we're really laser focused in on abilities to secure profits, to guarantee or lock in. I hate using the word. It's like buying insurance. Yeah, but it's insurance for for a heavyweight fight. It's like, sure, I'll still get in the ring. You're going to sell me insurance? Great. It's like, hey, buddy, that insurance may not do much for you, right? I say that because Bitcoin can be impossibly, technically, confoundingly, very, very complicated. You guys know that it can stretch you beyond your limits, as can day trading in general, Bitcoin specifically. Even the big shops, the big guys find it difficult sometimes to trade, but they're doing a pretty good job right now in New York. You guys know that. So again, the books in question, Murphy, Technical Analysis of the Financial Markets. Make sure it is by your trade desk or on your trade desk. Also and shout out to Tom Bolkowski. Tom, good buddy, in terms of that. And I appreciate all the ongoing interaction, Tom. If you don't have Tom Bolkowski's Encyclopedia of Chart Patterns, you're not going to know where the 80 to 90% of the pickups are. You're not going to know it, guys. And it doesn't do us any good just to sit here every day and go over and over those 80 to 90% pickups, whether they be on the long side or the short side, right? We'll spend some more time in the back with VIP going over that. Want to shout out to Luke. Want to shout out to J-Mac. Look forward to hearing all of your thoughts, all of your input, and how you can further advance this classical definition beyond the asymmetric, beyond the capital holdback portions of our understanding of hedge now, straight away into this classic definition and the interrelationship and how it frees you up to trade. These are the steps that I want us to continue to take in 2025. And as you see challenges, perceived challenges in the market, just know there's going to be maybe a bit of a learning curve and a bit of a stretch in terms of what you're used to in the market. In terms of technicals, pay attention to the 4 hourly, right? That 4 hourly, we're going to say the 4 hourly Bollinger Bands right now are in the mix, the pink line here. So bulls, you've got a little bit of a conquest here. Need to get back up and over that 4 hourly, 113 to 11, and hold. Looks like we have a bit of a broadening. Yeah, we go. Broadening bottom formation. These have been what? Recently. They've been, I'm going to say, what have we been, guys? 1 to 6 has been the ratio. 1 being a failure, 6 being completion of what? To the upside. So we're about shooting 5 out of 6 in terms of this being a bullish move. A broadening bottom formation has been the last 5 out of 6 times. You guys can check that, but it has been bullish, boom, to the upside. Barrier, you got it, 4 hourly, 20 moving average. So a little bit of a real tight wedge ongoing as well, if you want to look at that on that 4 hourly. This is London with MarketHedge. I appreciate all your patience, your understanding, and your willingness to engage in and learn the dynamics, computational dynamics, risk dynamics, profit dynamics. And these are things which, honestly, I invite you to interrogate AI about it, because for you to find an adequate resource material on hedging, it is not the easiest thing to do. So beyond New York Institute of Finance, and there are some complicated resources there, begin to interrogate your AI about hedging. Begin to discuss that with something that's got just a huge amount of information that is available to it, so that you can start to challenge it and it can start to challenge you further beyond the dialogue that we've had today. I appreciate all your time. New York is up and running. This is London with MarketHedge. Let's see if Bitcoin can do what? Operate once again. And what are we looking for? We're looking for an asymmetric move, right? Which is what? Which is a potential throwback. You got it. To a preceding flat bottom support. This is our target. So, and ideally we're structured what? To where we're not all in here, all right? We've got some degree of incremental exposure, absolutely. And we could say as well what? That the proportional exposure, right, in line with this classic definition, that ideally the proportional exposure, if we're counting for a move to the upside, would be in relation to a locked-in short, potentially. And if you don't short, don't start just to do this, period, please, okay? Learn the ropes first, okay? But as you would look at this, we can say asymmetric, we could say incremental exposure in terms of the margin, and we could say also now in relation to we'll just call it a cover hedge position, right? A hedge cover position, right? Which would be a short in this specific dynamic, if we're going after and trying to capture that classic definition of terminology of hedge. Guys, it's been a pleasure talking to you. We will keep this, and I'm going to require people to watch it, okay? I just am. And if you are required to watch it, congratulations. That means you just learned something, and there's a lot more to come from hopefully from you towards me as we continue this journey on MarketHedge. This is London, guys, with MarketHedge. Let's go Bitcoin. We've got a target to the upside, and yes, we do still have some targets to the downside, which merit quite a bit of heavy reserve cash. This is London with MarketHedge.